Hello and welcome to Fidelity Connects. I'm Glenn Davidson. The Bank of Canada has held its benchmark interest rate steady at 2.25%, marking its sixth consecutive rate hold. The bank says the Canadian economy is showing early signs of improvement after more than a year of sluggish growth, and it expects activity to pick up from here. But with trade uncertainty, geopolitical risks, and questions around business investment still hanging over the outlook, how durable is that growth story? And what does it all mean for investors, policymakers, and the path forward for the Canadian economy? Joining me now to help unpack it all is renowned economist Don Drummond. Don is the former chief economist at TD Financial Group and currently serves as the Stouffer Dunning Fellow and distinguished visiting scholar in the School of Policy Studies at Queen's University. Don, welcome back to Fidelity Connects. Great to see you today.
Thank you very much.
Don, I talked at the beginning in the intro about what the Bank of Canada has just done, and if I think about that and a myriad of other key things that are happening right now, we've got a lot of content that we can cover today, and it's wonderful to have you here for your perspective. Just based on air quality in Toronto today and out near Ottawa where you are and across the country, maybe I could start with this. Could you talk about the economic impact of the fires that we're seeing across our great country?
Well, I'm going to start off on what will seem like a reverse note. I'm almost happy to observe this. And the reason I say that is I've been trying to fight the fight on climate change since the early 1990s when we trekked off to Rio de Janeiro to start to what led the Kyoto Accord. And the notion of climate change and getting support to do something about it always seemed abstract. It's something in the future, it's something you can feel. You can feel this. You go out in Ottawa, or I'm sure it's even the index is even worse today in Toronto, and you go out and you feel that. We have done studies on that, and what people don't seem to recognize is that climate change itself is lowering growth. At the Climate Change Institute, we estimated that the future growth rate would be cut almost in half because of climate change. You get a diversion of resources from productive uses to repairing and replacing infrastructure for no other reason than what you had before is durable. And then the most important thing is not just the pure dollars and cents and gross domestic product, it's clearly affecting people's health. And just try to go outside and make it really, really personal. I just got an email from my pickleball club that activities are shut down for the rest of the day because of the air quality. Now that hurts, and that you can feel.
So it's a bigger picture than forest fires. It's quite broad, and as you said, there's a lot of work to be done.
Well, I find it's very discouraging. I completely understand and support the drive to bolster Canada's economic prospects, but we seem to be casting the environmental aspirations and policies aside, and I think that's a gross misunderstanding. It neglects the fact that climate change itself lowers economic growth. It neglects the fact that an Eco-Fiscal Commission, the Climate Institute, we've done our best to show credible studies. You don't have to sacrifice economic growth. And I find it fascinating that the leaders in clean energy in the world are China and the United States. So they speak one way, but they act another way. And Texas is the epitome. They bless the fossil fuel-based industry, but they're the second largest generator of renewable electricity in the world. But we're letting that opportunity go by. That clean growth could be a source of growth. We don't need to view it. You can have either the environment or you can have the economy. No, if you do it appropriately, you can have both.
Well, let me ask you about that on that topic. EVs from China being introduced into the Canadian market. What are your thoughts there?
I would certainly like to see them produced here rather than doing that. It's very disappointing to what's seen happen in the EV. We gave billions of dollars of studies on the batteries. They seem to be one way to be fading away. And of course, our great difficulty is that we're not at the moment, and perhaps going forward, we won't be able to export what we make tariff-free into the United States. And again, I feel somewhat like on the climate change. I have been warning people for a year. I think this disruption in trade with the United States is a way bigger deal than people think. You know, coming back to our topic of the Bank of Canada, they assume no further changes in tariff, and they assume that concerns about trade relationships will fade. And I go, why would you assume that? Do you totally believe what the Americans say, and Trump in particular, are not going to be followed through? The agreements the United States established with the European Union and Britain have base tariffs of 10 or 15%, and then the higher specialized tariffs. So I would love to see the batteries and I would love to see the cars made here. But until we don't have a big enough domestic market to support much of the production. So if we don't have access to market or we can't build access market to other economies, but by the way, they do make these in Europe. We just saw a big expansion, a huge plant going into Hungary to make Mercedes-Benz EVs. Other countries are playing in this game, and we're missing out on it. And in this case, we're going to import them, albeit a fairly small number.
Okay, you wove economic growth into that answer. Let's talk about the Bank of Canada. 2.25, 6 times in a row, it's been flat. There was, in the discussion from the bank, it looks like there's some feelings of confidence in the Canadian marketplace. I think that you would beg to differ.
The words at the beginning and the numbers do reflect that confidence. They, of course, had to knock down the 2026 GDP forecast quite a bit. It used to be 1.2 in the April outlook, and they knocked it down to 0.7. But that's just because the first quarter was very weak. They expect still to have a recovery, and just below 2% below that. So the signs are picking up. Of course, we had some terrible employment results for several months, but the last 2 months, while not particularly robust, at least been somewhat better. The terrible, terrible youth unemployment rate has actually come down a little bit, although it still remains very high. But their discussion of risks is very interesting. Almost all the risks they discuss, certainly in the growth, are to the downside. So speaking of the tariff assumptions, the very first thing they say, well, of course, the tariffs could go up. Of course, the trade uncertainty could remain in place. Well, of course it is. We didn't get an extension of the existing agreement. We're on to year-by-year review. So even if we do resolve something in the moment, this is going to go on and on and on every year. You're not going to build a big plant in Canada that needs to export to the United States, given that kind of uncertainty. I think that's a big deal. And then in terms of their economic growth forecast, where they have a very, very strong growth assumed for labor productivity, which we haven't seen in Canada for decades. The very first risk, they said, well, that might not be that strong because business investment won't be that strong. Well, again, why would business investment be strong if you weren't investing when you thought you had relatively free access to the US market? Why would you invest when you don't think that access? And we just saw that KPMG survey they released on July 7th of a large number of manufacturers, and a lot of them have already moved their activities in the United States, and an even larger number of them are anticipating doing it, and they're curtailing their investments in Canada. So I think we have some very dire challenges. We have the long-standing challenge of the low productivity, but now we have the additional challenge. We tied our wagon to one locomotive, the United States. That seemed like a logical and beneficial thing to do, but it's looking like a shaky arrangement at the moment.
And even mushrooms are going to be tariffed now going into the United States. What do we do about trade? What about the global reach that Carney is focused on?
I greatly admire what they're doing. I have to begrudgingly agree that we'll probably have to hold our nose and do some business with some regimes that may not be the most honorable participants in a lot of fronts, but let's recognize markets like China and India. They don't play fair ball. You say or do one thing China doesn't like, and all of a sudden some kind of pest is discovered in your soybean crop or whatever it's going to be. And hold our citizens without trials for long periods of time. India alleged to be interfering in our politics. These aren't going to be easy. We have this unfortunate interaction between the trade diversification and productivity. Every major European economy, with the exception of Spain, has a higher level of productivity. So without further weakness of the Canadian dollar, it's going to be a tough challenge all of a sudden to export to them. If you take our automobile industry as an example, we only make 10 models of vehicles, and 9 of them are large trucks. And I don't understand it, but the Parisians have yet to discover the allure of driving a big truck around the circle of the Arc de Triomphe. I think it would be a blast. You'd probably get in the inner circle and never get out in the rest of your life. But we're not making the product that they want, and we don't have a particularly high level of productivity. So these are a great deal of challenges. We will get a lift from the vast increase of spending in defense, but The IMF just did a study on countries that dramatically increase their defense. It tends to largely be borrowed, ends up adding to their debt. It gives an initial boom to GDP, but they're not used for economically productive reasons after that. So that's not going to be our savior either.
It's funny you talk about big vehicles in France. There's not much of an interest. I was recently in Italy and we saw a Fiat Topolino, which was very, very small. It was like a little golf cart. They're being introduced into the United States, I think, in the next year at about $15,000 a piece. I don't know who's going to want to drive one of those around with all the big trucks surrounding them on the highways.
Well, and of course, Mercedes learned that lesson with the smart car, the tiny little thing that you can come pretty close to lifting up yourself. They've stopped exporting them to the United States, and they're not being sold to Canada anymore. So it is kind of discouraging in a way. No disrespect to Ford and the Ford 150, but that's the #1 selling vehicle. And the vast majority of people have never once used its capacity as a truck. They just like some gigantic vehicle for some reason.
With a passenger of one. You referenced that KPMG study, and it's scary to think about companies saying, we're moving shop, moving our head office to the United States. I recall a lot of companies in the 90s, early 2000s being bought by US companies, got a great Canadian companies, but still kept production in our market here. Is that something that you have also noticed? You referenced it through the study, but is that something that you're seeing a lot across the country?
Yeah, we are beginning to see that. And I think there's a very important point of clarification that needs to be made on that KPMG study, and that is almost all of the products made by the respondents are CUSMA compliant, meaning at the moment, these manufacturers are not being affected by the US tariffs. So keep in mind those two sides of that. They're not being affected by the tariffs, but they're cutting investment. They're moving out of Canada because of trade uncertainty. So that shows a great fear that we haven't seen the worst of what's going to happen to the US-Canada trade relation. And I've been saying that I remember I harshly criticized the January 2026 monetary policy report when they said that they expected trade uncertainty to dissipate through the course of 2026. And that statement came 2 days after our departing Canadian ambassador to the United States said she expected no resolution to CUSMA in 2026. Neither a definitive walk away from the United States, nor a definitive sign on, nor a definitive new agreement. And so far, she is looking like she was right on the money on that. Why do you assume everything's going to work out so smoothly? Unfortunately, these manufacturers aren't. They're very worried, and they're acting with their feet and their money and their head personnel.
You also mentioned youth unemployment, and I'm curious if you think that that is just because there are fewer opportunities. Is it an AI issue? Or, and I'm showing my age here, is it a generational issue as well?
I think all of the above. There have been jobs in the trades. More young people are going into the trades, but that's not typically the avenue. Trade profile is normally typically an older male, not that many females, but again, that is going on. You look at trucking has been looking to hire people, but again, they don't tend to be the younger people, and it tends to also be male oriented. Of course, more and more people are going to some form of post-education, and that's where the jobs would be, but they haven't been of late. The financial sector is not on balance laying off people, but it's not hiring people the way they were before. The universities in Canada, for deliberate policy purposes, the federal government to some degree, but certainly some of the provinces of Ontario and Quebec have decided to push them to the brink of bankruptcy, so they've been cutting back. So some of the typical avenues have been relatively constrained. We have, unfortunately, the dynamic. We have some excellent universities producing high skilly graduates in AI and just generally in IT, Guelph and Waterloo just being two of the examples, but they're typically getting hired by the United States with much higher salaries. So we haven't seen that kind of avenue for our youth. So very, very tough to get a summer job this time, very hard to get in. I teach in the School of Masters of Public Policy in Queens, and our graduates are fighting to get co-op positions and then hoping at the end of the co-op to get 1-year contracts, and at the end of the 1-year contract getting hope for the second. They're typically getting employed, but keep in mind They are not getting benefits. They're not getting pension entitlements. They typically don't have sick or dental benefits. They're appreciative to get what they can, but we go back and in the old days in my graduating class, all but two had a permanent, indeterminate job with a full suite of benefits already locked in before we wrote our final exams. That's not the market these days for the young people. AI is part of it. A study just came out and showing working from home as part of it. It's increased the flexibility. It has kept a lot of the older workers in the market longer than they might have been otherwise. You can't be bothered going and getting dressed and going to the office. Guess what? You don't need to.
So true. Let's talk about Canada being in a technical recession, perhaps versus being in a long-term recession.
I always feel it's an unfortunate discussion because it camouflages the seriousness of our situation. I don't particularly care about the outcome 1 or 2 quarters. We have been locked in a very low growth scenario for a long time, and that's what we should worry about. Whether it's minus 0.10 or zero point 0.1 should be a trivial matter that doesn't get anybody's interest. I think if we measured our economy on a more appropriate basis, and that would be our output per capita, we would have caught on to this long ago. The weakness of the Canadian economy got disguised by unprecedented population growth. We had 3 years in which our population increased about 3% a year. We had growth that we've only seen 1 year in our history, going back to 1956 with the mass exodus from Eastern Europe, particularly from Hungary. It didn't get repeated. We were having over 1 million immigrants come in, and the GDP looked reasonable, but it was declining on a per capita basis. Ironically, on a per capita basis, output actually increased in the first quarter. Our population is declining. I went on a rant for the last 6 months trying to educate the population and economists and the media to reinterpret things. And when you say employment was weak because it only went up 10,000, I point out 10,000 in the context of a declining population and a labor force that's declining more is incredibly strong. That does not indicate cyclical weakness whatsoever. That is a structural issue. A normal employment change this year would be a decline of 4,500 per month, and it would be a slight decline even next year as we adjust from unprecedented growth in our population to population declines for a while. This is not a criticism of the change in immigration. As then Minister of Immigration, Mark Miller, said, the system has got out of control. I admire his bravery for saying that, but they do say, well, wait a minute, you're responsible for it. And it's not very satisfying to hear somebody just say their own programs got out of control. The complete lack of mindfulness about the number of immigrants coming in and the difficulty of getting access to affordable housing, over 6 million Canadians not being attached to a regular primary caregiver, is like the government just operated in silos. So it needed to be addressed. It is being addressed, but that's going to give us weak growth for a while. And that doesn't indicate a cyclical weakness. And it certainly doesn't indicate the Bank of Canada needs to do anything more to stimulate the economy.
You've certainly given us a lot of the status of where things sit today and the reasons behind that. But we have had a question come in from one of our viewers, and it was about what failed government policies have gotten us to where we are now, and what perhaps needs to change going forward.
Well, I'll start on the monetary side. I have been a critic of the central bank here and elsewhere for a long time. They needed to stimulate following the financial crisis in 2008, 2009. But they left interest rates and monetary conditions too loose for far too long. All it did is get capitalized in asset prices, particularly in housing prices. We didn't get any break in home affordability. The mortgage rates were lower, but the housing prices went through the roof. So I think that was an error. And of course, that amount of stimulus led to a runaway in inflation for a while. That was definitely a policy error. Obviously, compounded by the supply chain shock from COVID, but the conditions weren't right. On the fiscal policy side, we had established reasonable fiscal discipline in Canada going through until 2019, and the gates just blow away. Again, for a while it was necessary, but the government of the day seemed to be drunk on making multi-billion-dollar spending decisions every single week and just wanted to have all these press releases. Spending totally went out of control. Even with what the Carney government talks about is spending cuts, the ratio of program spending to GDP by the end of the budget period 2030 is still well above what it prevailed in the 2000s and the 2010s. So we have spent unwisely as well. We have not reformed our corporate taxes. We did through hard work, actually temporarily created a corporate tax advantage in Canada, but we've lost that as other countries have reacted. And one of the factors that the companies who were leaving Canada cited was an uncompetitive tax situation. So we need to look at that. We have preserved this perverse distinction in the corporate tax regime with small and big businesses and made it worse. The Ontario government just allocated 1.3 billion over 3 years to lower the small business rate for 2.25%. We desperately need to encourage corporations in Canada to grow. Instead, we reward companies for remaining small. Larger companies produce more, they're more likely to export, they're more likely to do research and development, they pay better, they give better benefits. You typically start small, but we want to encourage them to grow. And if you want to give a preference, it should be by the age of the firm, not by the size. Give them a break when they start, but don't reward a company because it's small after 50 years in existence.
Well, you wove in some really interesting ideas of what can make things better. Another key point I want to ask you about, as of today, as of us doing this webcast, gold dropped below 4,000, and it's been on quite a ride the last year in particular. What are your thoughts on gold?
This is where most listeners have to turn off their headphones at this point because I would have cost them a lot of money. I have and remain perplexed at gold. Is an asset that has no rate of return. It doesn't pay an interest rate. It doesn't pay a dividend rate. It actually has transaction costs. It has very few commercial values. Yes, it's in a little bit of jewelry. It's used a little bit in industrial purposes, but it's basically like cryptocurrency. It is has a value just based on people, whatever value they assign from it. And whenever there's any scare, it goes up through the roof. And I would not have predicted, sorry, just say, admit that, I would not predicted it got that high. I still don't understand it. I don't think it's validated for any economic or investment reasons. It's a highly risky thing that is not giving any rate of return other than the asset appreciation, and it's vulnerable to decline. But again, if anybody had listened to me and followed my advice, they would have missed out on making a lot of gains to this point.
Well, you worked crypto into that answer, and so I'm not going to ask you about that, but I do want to ask you because you talked about I think you're saying gold got over its skis, and it makes me think about there's a parallel to AI investing today. Valuations are tremendous. The punishment for earnings coming in at or slightly below what expectations are has been enormous, like with IBM a couple of days ago. Do you think that gold is foreshadowing what could happen in the market?
I am no doubt reflecting that I am relatively risk averse and a conservative person. I tend to worry about the downside, and I'm incredibly worried about the downside. I think we have seen this movie many, many times before, where companies and sectors who have yet to turn 1 cent a profit have these billion and even trillion-dollar valuations, and they ultimately don't end up fulfilling that. And AI is ultimately the big thing, and it's increasing its applications, but does it justify the valuations we have right now? I hate to say anything negative about you look at the TSX, you basically got natural resources and you got the financial companies, and the financial companies, the stocks have been increasing absolutely incredibly, but their business generally reflects what's happening in the Canadian economy, and the Canadian economy is facing these crises. Weak productivity, lack of access to the US trade market. Does it justify those kind of valuations? And yet they keep going up. And when we were chatting the other day, we talked about when the ceasefire was announced with Iran, that everybody wanted to break out the champagne and it's over. And they go like, this didn't resolve anything. This is not over by any measure, but people so badly wanted it over, and they were driving the valuations from that. And you sort of wondered, why is there not more a calmer, more realistic assessment of the situation that this is going to last for quite some time and it's going to disrupt global supply chain and it's going to keep oil prices up and it's going to affect fertilizer and a whole bunch of other things. But I'm extrapolating. I see these core economic challenges that Canada is only half-heartedly trying to address, and I have to worry about that. But I see these sky-high equity valuations.
We've had a question come in as well on housing. It seems unattainable to so many people, and you mentioned earlier about multi-unit housing perhaps being needed because of immigration, and there's really nowhere to go. What would have to happen for, I hate to say this, for a correction in the housing market in Canada?
Well, the first big thing happened, and that was, bless the heart of whoever created economics as a discipline, because there's only one idea behind it, and that's there's a supply and demand, and there's a price that clears the market. So the demand was going through the roof with over 1 million immigrants coming in, and the supply, we're having over 1 million. That's about over 500,000 households, and we're building about 225, at most 250,000 units. Well, you can do the math of that. The price is going to clear that market is going to go up and up and up, and now we've got a population declining. And we're seeing in the major centers, which used to be the recipient of most of those immigrants, like Vancouver and Toronto, we're seeing prices come down quite a bit, particularly coming down in the condo market. So I would say the first basic thing has happened. The second thing has happened to a mild degree. People in 2021, they hit the lottery. They were getting 5-year mortgage rates at 1.65. Well, those are gone. By an historical standard for anybody my age, current rates still look low, but they don't seem that way to anybody else. But that has made it, that will curb the demand side. We are not seeing the supply increases that government's committed to, whether they're federally, provincial, or municipal. And we're seeing mighty resistance at the local level to increases in density. So we're not going to see the breakout of the supply, but the demand side. I am very much thinking right now of whether there's a further downward potential of housing prices. The IMF kind of rocked everybody in 2021 when they said housing prices in Canada will come down by about 20%, but they did, because they were out of an equilibrium. Most of the forecasts don't show they're going to go down, but I don't think they think very much of whether we're in equilibrium. I think there still is a further potential. If you look at housing prices relative to income, if you look at it, the monthly cost of owning and operating a house, it's still very high. If you look at the relation to income in other countries, it's still high. So I think there might be still some downward movement, but we have seen some increases in availability, and we're certainly seeing large declines in condos. Anybody's still interested in buying one, particularly, and there seems to be a consumer sentiment change. When the affordability got really bad, we saw the outburst of these even 450 but 500 square foot condos, and there's definitely seems to be a shift in taste away from them. So they're going at much lower prices.
You've given us a real strong reality check today, and we're not going to finish on the note that we just discussed. You did weave in some optimism, though, and I want to leave with this. What makes you optimistic about the Canadian market today, and what do all of us as Canadians need to start doing this afternoon to create a better reality?
Two things I bear in mind, and I've thought of this analogy before. If you're an alien that decided to do a tour of the world and you're looking down there, wouldn't you think Canada is pretty attractive? Well, we got a great location. We have access to all three sides have access to the ocean, and given the St. Lawrence, that access even goes right into it. We have lots of natural resources. We have lots of critical minerals even. We've got obviously the fossil fuels. We have tremendous capacity in electricity. We have tremendous capacity in low emission electricity. And that's on the natural resource, the endowment side, but we've created a highly educated population. We have a highly diverse population. I well remember when I wanted to do some business in China, the person who ultimately made the decision was a graduate of the University of Western Ontario. When the CEO said, "I have no evidence that that had any bearing on the decision, but it certainly made me feel good." But we have lots and lots of situations like that. So we have what's required to do very well. I think, as Michael Sabia said when he was departing from his job in Quebec, we have an ambition deficit. But I think we have the assets, we have the material to do well. And the second thing, I have been critical of various things even today of what the Carney government is doing. But I do admire they're not sitting around idly and just saying we're in trouble and we're going to watch how it plays and see what happens. They're moving fast on many fronts. I think they need to move fast on even more fronts. And I fully recognize that that's a very, very difficult task, but they seem to be up to the game. And people like us here today can nudge them in the right direction. I think we have scope after a few probably rough years of coming out of this quite well. And maybe as stereotypical, having had looking at the precipice of a cliff, maybe we'll come out stronger than we were before, and with an economy that's not just tied to one and a more resilient structure to the Canadian economy. There's hope.
Hope. I love that optimism. What a way to finish. Don, thank you for your insight today. It was wonderful to talk to you.
Thank you very much.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.